Coming up, home values near their record, what the Reserve Bank Governor had to say about yesterday's inflation numbers, and the Australian dollar at the lowest point so far this year. That's next. It is your daily 10-minute business and finance news wrap for this Thursday, the 26th of October 2023. Later on market day, we will speak with Damien Boey from Barrenjoey for the latest on the markets, including the slide in the Australian dollar. But first, let's talk property prices and domains, as prices are near their peak. The median house price of $1.072 million is just 0.2% below the national record. For units at 6,222,000, that's just 0.8% below their peaks. For more, Rhayna Bosch spoke with Nicola Powell. She's the Chief of Research and Economics at Domain.
Really defies the odds, the fact that we've got such high levels of inflation and seen such a high change in the cost of actually holding debt at a time when our housing market is well on its road to recovery. Across our combined capitals, only needs an extra $2,000 for house prices to be at a new record high, and for unit prices only $5,000. So we are anticipating that those records are going to be achieved by the end of this calendar year. And there are some strong reasons that continue to boost property prices. And initially it was really a lack of supply. That was really the fundamental aspect that really placed a floor under pricing and boost pricing earlier in the year. We have started to see new listings increase, but many of our capital cities are grossly undersupplied and well below their 5-year averages for the time of year. When you look at some of the other reasons, we've got high levels of construction costs, so there's really a mismatch between purchasing new and purchasing established. And I think what it's actually doing is pushing many buyers to actually purchase an established property, because the cost of construction, the cost of new builds has blown out so significantly compared to before the pandemic. We've also got tight rental markets. We've got a national vacancy rate that's at a record low of 0.8%. In some of our cities, it is like trying to find a needle in a haystack in terms of locating an empty rental. Some of our cities, so Adelaide and Perth, have got a vacancy rate sitting at 0.3%. And I think what that does in itself is it diverts and drives demand away from the rental market and into the sales market. I think we're seeing first home buyers fast track their decisions to purchase because the rental markets are so tight. And then anyone coming in from overseas are likely making a purchase because they're just unable to find a rental accommodation.
Now, Nicola, before we delve in a little bit further in terms of what that kind of means for buyers and homeowners, can you first just give us a breakdown in terms of where the price rises are most evident?
We've even got some of our capital cities at record highs. So Perth and Adelaide house prices at a record high, and unit prices in Brisbane and Adelaide are also at a record high. But in terms of price gains as well, Sydney continues to lead the recovery. We're seeing it much more established, and it's almost at a new price peak. I think it's only about 0.8% that separates Sydney house prices from a new record high, and that's likely to be achieved by the end of this year. Brisbane isn't too far behind either. We are also anticipating that house prices in Brisbane will be at a new record by the end of this year.
Now, yesterday we had some inflation data come out, and economists are now turning their attention towards a potential rate hike. What could this mean in terms of impacts on the property market?
It is concerning that inflation was higher than initially anticipated. And I think what that does is actually places more pressure on the RBA to hike that cash rate, either in their November board meeting or December. It's very much likely that we will see another rate hike. But I do think the overall impact on the housing market, I think prospective buyers out there will already been pricing in perhaps a rate hike. And I don't think buyers out there are really extending themselves to their maximum borrowing capacity anyway, because of the high cost of debt, but also the high cost of living. I think we've all been building in a buffer to be able to really meet those mortgage repayments. So whether or not it will have a dramatic impact on our housing market, I actually don't think it will.
We heard from Reserve Bank Governor Michelle Bullock this morning talking to rental pressures. You spoke about it earlier as well. So what does all of this mean for people who are looking to potentially purchase a home?
It is an extremely tight rental market. It's a rental crisis in many areas across Australia. That vacancy rate has hit a record low in September, 0.8%. So it is challenging, and more challenging in some cities than others. I think what that does mean, I think some tenants are actually fast tracking their decisions to purchase, but with rising property prices and the higher cost of debt, it does become a financial burden. It's hard to get into the property market. I think what that means for first home buyers, compromises are being made, and that in itself is helping to steer demand towards more affordable property types or more affordable locations. And I think that's why in some areas we're actually seeing unit prices outperform house prices because of that affordability aspect.
Nicola Powell there from Domain.
Now, Market Day on the SBS On the Money podcast.
The Australian share market fell today. The S&P ASX 200 down 0.6% to 6,812. The Australian dollar also reached a 2023 low against the US at 62.7. For more about the currency impact, first I spoke with Damien Boey from Barrenjoey.
There's a couple of things. So one of them is that US bond yields are going back up, and US yields are going back up because we have some very unstable dynamics happening in fixed income at the moment. So what's going on there is that large asset allocators who usually spread their money across bonds and stocks are finding that there's no diversification between them. When the stock market moves up, bonds move up. When the stock market moves down, bonds are moving down. And so what the asset allocators are saying is, look, if I'm being asked to take up more bond issuance, I really need to have a cheaper entry price or a higher yield to get in, because actually I'm not getting any diversification benefit. So this idea is actually really driving up bond yields, and it's a very difficult issue to resolve. And it's almost independent of what the Fed will do next. So that's one side, rising US bond yields. A second part of it has got to do with Australia. So there is a little bit of confusion as to what the RBA's next steps are going to be. If you look at this morning's talk from Michelle Bullock, she's basically suggesting that maybe the hot CPI number that we had yesterday is not enough to cause a material revision to the RBA's outlook. And that's something that our economist Joe Masters strongly agrees with. However, you've also got other commentators suggesting, including former Assistant Governor Lucy Ellis, suggesting that, well, maybe there is enough to see a material revision. So what you're seeing at the moment is that the bond market, bond yields are going up, partly on Lucy Ellis's comments, and what you've got is that the Australian dollar is going down on Michelle Bullock's comments, and there's a bit of a disconnect that needs to be resolved there.
What's the market actually thinking will happen with interest rates then?
So the market's thinking that you are going to see a rate hike either in November or December. So it's not 100% convinced that it will be in November, but if it's not November, then the market's saying December.
At what point do you think it's a concern? If it's down at about 62.8 at the moment, at the time of recording, at what point does the RBA go, oh, we're now worried about the low Australian dollar? And what about investors and the implication for investments?
Yeah, so for the RBA, I guess they need to have a look at what financial conditions are looking like generally across interest rates, exchange rates, asset prices, and things like that. So across the board, most people would argue that the Australian dollar is quite undervalued at the moment. And the undervaluation, therefore, is providing a form of stimulus to the economy via the external sector. What will be confusing for the RBA is, of course, if economic growth expectations globally are coming down, then maybe the Australian dollar coming down is actually giving us a negative signal, which is hard to kind of interpret at the moment. So for the RBA, the Aussie dollar going down is very ambiguous. There is an imported inflation argument that comes out of the Aussie dollar coming down, but by the same token, like as world growth slows and as supply chains ease, well, actually we're not seeing the lower Aussie dollar drive up import prices. So my gut feel is that as I look at the Aussie dollar falling, there are too many components, too many mixed signals from it for the RBA to really be concerned about it at the moment. Now, for investors, it's actually very clear. If the Aussie dollar is going to fall like this, then you want to have companies in the Aussie market that have US dollar denominated earnings because they will gain on translation benefits. Most people would look at names like healthcare, CSL, Cochlear, ResMed, Sonic, those sorts of names because they have very strong US dollar exposure. The problem is that the Australian dollar is coming down while bond yields are going up. And bond yields going up are not good for those growth stocks that offer you long-term returns, long-term payoffs, not short-term payoffs. So the healthcare names, although they are dollar earners, are actually going to be caught between higher bond yields and a weaker Aussie dollar, and it will be quite ambiguous. Where there is real value is in commodities. The reason why people say the Australian dollar is undervalued is because commodity prices actually haven't come off that much, despite all these concerns about world growth. We have oil prices that are up in the last few months. Gold prices are starting to rebound. Even iron ore prices have started to levitate on China stimulus speculation. So what that means is that for many investors, they are looking at Australian dollar denominated commodity prices actually at record or cyclical highs. And if you value Australian companies, whether you're talking BHP, Rio Fortescue, Sandfire, South32, Santos, or any of these companies, for where Australian dollar commodity prices are right now, the stocks actually look very, very cheap. So to me, the implication is quite clear. You actually want to be buying resources companies at the moment.
That's Damien Boey there from Barrenjoey. This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial